Hello and welcome to FAR-4. So guys, we've been going pretty steady with FAR and that day is not too far when you guys know all about financial accounting and reporting and you become rich, successful, certified public accountants. So guys, before we move forward, let's quickly recap on what we've learned so far. So in FAR-1, I give you the financial statements. So I give you the balance sheet, I give the income statement, the statement of comprehensive income, the statement of stockholders' equity, statement of cash flows, and a lot of notes to all these financial statements. So that was all financial reporting. And then from FAR-2 onwards, we started looking at items on our balance sheet. In FAR-2, we looked at current assets and current liabilities. So we talked about cash and cash equivalents. We looked at accounts receivable. We looked at inventory. We talked about accounts payable, contingencies. Then in FAR-3, we moved down on our balance sheet on the asset side and we started looking at non-current assets also. So we started with investments. So remember 0 to 20% investments. That was cost method or marketable securities. 20 to 50%, that was equity method. More than 50%, that's when you consolidate. We didn't learn about that yet, but we'll learn about that in FAR-6. Now, then in FAR-3, we moved on and talked about PP&E, that was your property, plant and equipment. We looked at intangible assets. Remember patents, copyrights, trademarks, they had an indefinite life. Then we had goodwill, indefinite life, unidentifiable asset. Now, in FAR-4, we're going to be focusing on this side of a balance sheet. So we'll start with talking about bonds. So let's say we at Miles CPA Review, we're growing and we need money. We've put in a lot of equity, but now we're thinking of borrowing in debt. So we issue out bonds. So we are the issuer of the bonds, we're the borrowers, and that becomes bonds payable for us. So we issue out bonds, get in cash. So guys, that becomes a non-current liability on our financial statements. Then after bonds, think about it, we've gotten in a lot of money, we need training centers also. So we lease out a training center, let's say 25,000 square feet for a period of 50 years. Guys, we didn't buy the training center, we leased it out. But we leased it out for a long 50 years. By the time we are out of there, the building's going to crack. So though it's not our property, it's not our asset, but still, in substance, we sort of own the property. Think about it. The landlord, the lessor, he owns the asset in form, on paper. But in substance, we're going to be using that asset for literally all of its life. So it's actually our asset, our right. So we're going to have a leased asset in these capital leases. We'll talk about that. But to have this asset, we're going to be paying out monthly lease payments. So that becomes a lease liability for us. Then let's think about it. To make this company a success, we need a team of wonderful employees. And I've got Jay and Abdul here. Now these guys are really hardworking. They've been putting in 80 hours per week to make all this content so that you get all your information. Now, from next week onwards, they're planning to put along 100 hours per week. So guys, think about it. We're going to take care of them. Now, we're going to be taking care of them now. We're paying them salaries and bonuses. Now, we also want to take care of them even after they retire. So we want to be paying out pensions to them. So guys, that's something to be paid out in the future. But still, it's a liability as of today. So we're going to talk about pension liabilities, their retirement benefits. Now, because it's so huge, what we might do is every year when we earn some money, we might put aside, we might invest that money so that we have the cash flows when we need to pay them pensions later. So that might become pension assets. So guys, as you can understand, I've told you bonds, I've told you leases, I've told you pensions. Now, to understand all of these, so these are future non-current liabilities, having cash flows in the future, periodic cash flows. To understand these properly, you need to know the concept of time value of money. And we'll look at that in just a moment. On FAR-4, page 1, let's look at all the content that we're going to be studying in FAR-4. We're going to be starting with present value and annuities, and then we'll learn about applying the present value and annuities concept to bonds, to debt restructurings, to leases, and to pensions. So as you can already understand, there's a lot of content in this chapter, but this one is really important for your CPA exams. So let's kickstart with the present value concepts, and then we have a lot to come in this chapter. Now guys, let's say I offer you $100 now and $100 a year later, and you're going to choose between the two. What are you going to choose? So Jay there, he says he wants it now. What if I say I'll give you $100 a year later, but if you want it now, I'll just give you $91. Then my friend Jay there, he is indifferent. He says anything is fine. So guys, what this means is the $91 that I'm ready to pay now is growing to $100 in 1 year. Guys, that is the concept of time value of money. So let me put it here. What we can see is $100 after a year is worth $91 today. Or in other words, the present value of $100 after 1 full year is $91 today. You could also say that the future value of $91 today is $100 after a year. Now, this is assuming a 10% interest rate. So let's look at the present value tables that we have on our book. So the present value of $1 at 10% after 1 year is 0.909, or let's say 0.91. So guys, you got how I calculated this number, $91? I multiplied the $100 after 1 year with this present value factor, present value of $1 after 1 year at 10%. So $1 year later is worth 91 cents today. So $100 a year later would be worth $91 today. So let's do that for the second year. So how much is $100 after 2 years worth today? Or in other words, what is the present value of $100 coming in after 2 years at 10% interest rate? So we're looking at two things. We're looking at the time, the year 1 or year 2, and we're looking at the interest rate, 10%. So we're keeping it at 10% for now. So looking at that, we have 2 years, 10% gives us 0.826. We could say 0.83. So the present value factor for 2 years, 10% is 0.83. That's for $1. So you could say $1 coming in after 2 years is worth 83 cents today. So how much is $100 worth? So that's 100 into 0.83 gives us $83. Now let's go to the third year now. So now we're looking at year 3, and again let's keep it at $100. So how much is $100 coming in after 3 years worth today? So let's look at the worth of $1. So $1 would be worth 0.751, or let's say 0.75. So what we're saying is $1 coming in after 3 years is worth 75 cents coming in today. $100 after 3 years is worth $75 today. Now let's move on. Fourth year. Again, $100 coming in after 4 years, long years. The present value factor, so I'm looking at the 10% column and the 4-year row, and that is 0.683. 68 cents. So a dollar after 4 years, the present value of that dollar is 68 cents as of today. The present value of $100, that's going to be $68. Then if you look at year 5, another $100 coming in, and I want the present value number, which is 0.621, so 0.62, and that is worth $62 as of today. So guys, as you can see, what I've done is I've used the present value factors from the present value tables that you have on your book, and I have calculated the present value of money flowing in after a period of time. So present value of $100 flowing in after a year is worth $91 today. Present value of $100 flowing in after year 4 is worth $68 today. Looking at it the other way, the future value of $91 today is $100 after year 1. You could say the present value of $75 today is $100 after year 3. So guys, that is the concept of present value. We look at future cash flows, get it to present date. Future value, you look at current cash flows and you get them to future dates. Now, when I look at this cash flow, this is a periodic cash flow. Let's say $100 comes in after year 1 and it also comes in after year 2 and after year 3 and year 4 and year 5. We could call such cash flows annuities. So if I'm having such a consistent cash flows of $100 flowing in for the next 5 years, how much is that entire cash flow, that entire annuity worth today? So we've been doing that, right? So we did $91 for the first year, $100. $83 for the $100 that's coming in after year 2. $75 for the $100 that's coming in at year 3. $68 for year 4 and $62 for year 5. Now, if I sum all this, I'll get the worth of this entire cash flows as of today, the present value of all these cash flows. So let me sum it up. So 1 plus 3, 4, 4 plus 5, 9, 9, 17, 19, 9, 1 goes up, 10, 18, 25, 25, 31 and 37. So this gives me 379. So guys, if you don't remember all these calculations from school, you can use a calculator on your CP exams, don't worry. Now, so what I'm saying is these cash flows over 5 years is worth $379 as of today. So now, instead of doing all these calculations, 0.91, 0.983, 0.75, 0.68, 0.62, so that was present value of $1 after each year. I could have instead used a present value of annuity table. It's the same cash flow coming in every year. So if I use the present value of annuity table, so if you look at that, the present value of an ordinary annuity. So this annuity is coming in for how many years? 5 years. So I'm looking at the 5-year row. What's the rate of interest? 10%. So 5-year row, 10% column, and I get this number 3.79. So guys, it would have been so simple. Instead of doing all these calculations, I would have simply done $100 into 3.79 would have given me $379. Simple, easy. So guys, what you could say is the present value of ordinary annuity of $1 for 5 years at 10% is 3.79. So let me write it. The present value of ordinary annuity. Now, we're calling it ordinary annuity because the amount is coming in at the end of each year. Ordinary annuity, that's also called annuity in arrears. So guys, as you can understand, the money in year 1, it's coming at the end of year 1, and that's why it's worth only $91 today. The money, $100 for year 2, it's coming at the end of year 2. So ordinary annuity. Annuity in arrears, it comes after the year ends. So the present value of ordinary annuity of $1 at 10% interest for 5 years is 3.79, and this is something I've picked up from this present value of ordinary annuity table. Now I've picked up this 3.79 and I simply multiply it by $100 because $100, that is the same number coming in every period. So I get 379. Makes it simple and easy. So that was an ordinary annuity, annuity in arrears. Now how about if this amount, $100, is coming in at the beginning of each period. So let us say, if this $100, instead of coming in at the end of year 1, comes in at the beginning of year 1. And let me use a blue pen for this. So if this comes in at the beginning of year 1, guys, what is the present value of $100 today? $100 today is worth $100. Simple, easy. A kid would say that. So the present value of $100, which is coming in at the beginning of year 1, is $100. So this is no longer 91. Because in case of an ordinary annuity in arrears, we were looking at this $100 coming in after year 1. Or rather, when we did the present value, 0.91, we looked at this $100 coming in after year 1. Now, we're talking about a different annuity. Annuity due or annuity in advance, where money is coming in at the beginning of the period. So if it is coming at the beginning of the period, this $100 is worth $100. Now when I look at the $100 coming in at the beginning of year 2, guys, just to distinguish, I'm using a blue pen. So beginning of year 2, guys, beginning of year 2, so the 1st January of second year is more or less the same as 31st December of year 1. So end of year 1 and the beginning of year 2 are sort of same. So you could say the $100 which is coming in at the beginning of year 2 is worth $91 today. You could also say the $100 that is coming in at the beginning of year 3 is worth $83 today, not 75, 83. 75 was when the $100 was coming in at the end of year 3. Now, this $100 is coming in at the beginning of year 3, so it's worth 83. $100 at the beginning of year 4 is worth 75. So, beginning of year 4 is the same as ending of year 3. Beginning of year 5 is the same as ending of year 4, and it's worth $68 today. So guys, now if I look at this annuity in advance, so I would say the present value of annuity in advance or annuity due. So okay, this was annuity in arrears. This is annuity in advance. This was ordinary annuity. This was annuity due. And if we total that, so 91, so 1 plus 3, 4, 4 plus 5, 9, 9 and 8, 17, 7, 1 goes up, 10, 18, 25, 31, 3 goes up, 3 and 1, 4. $417. Or you could say, we could do this we've done this $100 into 1. The amount that's coming in on day 1, that's $100 into 1. Plus $100 into present value of ordinary annuity for 4 years. Because guys, though this amount is coming at the beginning of year 2, that's same as end of year 1. Beginning of year 3, same as end of year 2. So we could look at the ordinary annuity for 4 years. So now if I look at the present value of ordinary annuity table for 4 years at 10%, I get 3.17. So it could be $100 into 1 plus $100 into 3.17. So that gives us $100 into 4.17 or $417. So you could say the present value of annuity due, not ordinary annuity due now of $1 at 10% interest for 5 years is 4.17. So 1 plus 3.17 gives me 4.17. So that is the concept of ordinary annuity versus annuity due. So we've looked at two things now. First, we've looked at present value of $1. So if we didn't have this entire cash flow, we just have this one number coming in. The present value of $100 after year 1 would have been $91. So that was basically when you have a single cash flow after a point in time. Or let's say we didn't have any of these cash flows, we just had $100 after 5 years, not beginning, end of 5 years. That would have been worth $62 today. So that would have been a present value of $1 after a certain period of time at a certain interest rate. So that was the present value concept. Then we started looking at annuities, a series of cash flows. Now because the series of cash flows are same numbers, what we did was instead of calculating so many present values, we simply looked at the present value of ordinary annuity table. So when we had the series of cash flows coming in at the end of each period, we call it ordinary annuity or annuity in arrears. And we said $100 into 3.79, that was the number for $1 for 10%, 5 years, and we calculated that's 379. If the annuity was for beginning of each period, so the money was flowing in the beginning of each period, then it was an annuity in advance or annuity due, and we said the $100 that's coming in at the beginning of year one, that's worth $100. But for the remaining cash flows, we will still use the present value of ordinary annuity table. So we used it instead of 5 years here, we used it for 4 years here, and we got 3.17. So 3.17 into 100 was $317 plus $100 gave us $417. That is present value of annuity in advance, annuity due, $100, 5 years, 10%. So guys, you're looking at number of years and you're looking at the interest rate. Let's get to the book and look at it again. This is the concept of time value of money, and as I told you, we're going to use this concept, very important. We're going to use this to understand bonds, to understand leases, and to understand pensions. On page 2, second bullet, let's look at annuities. Highlight ordinary annuity or annuity in arrears. Underline end of each period. Next one, highlight annuity due or annuity in advance, and underline beginning of each period. Then looking at the present value tables, put a box around present value of $1 and write use for single future cash flow. Then put a box around present value of an ordinary annuity and write use for stream of future cash flows. On page 3, we got present value and future value tables. The focus is on the present value tables, where we have a present value of $1 table and present value of an ordinary annuity table. Now naturally, I don't want you to remember any of these numbers that are there on these tables. On your CPA exams, you're going to be having pieces out of these tables on your problems. So you need to be comfortable on picking up the right present value factor. So you should be aware that the columns, we are looking at the discount rate, the percentage. On the rows, we are looking at number of years. Turn on to page 4, and on the second sub-bullet there, we're looking at converting from present value of ordinary annuity to put a box around present value of annuity due. So if you're given the present value of ordinary annuity tables and you're required to calculate the present value of annuity due, you can very easily do that in 2 steps. Like step number 1, on ordinary annuity table, look out for present value of n-1 periods. So let us say if it's present value of annuity due for 5 years, on the present value of ordinary annuity table, you're going to look at the row for 4 years and take out the present value factor for that. And step 2, to the above present value factor, add 1. This gives you the present value of annuity due.